Good evening. My name is Bruno Lippens. I'm one of the lead managers of Gloin, and today I would like to talk to you about inflation and how it impacts the utilities business model. We obviously all know that we've moved from a period of very low inflation to a period of relatively high inflation, and that's a global phenomenon happening around the world. And it's causing a lot of uncertainty in a lot of business models, and it's causing financial markets to be nervous. We do think that Gloin investors should not be too nervous about inflation for two reasons. First of all, inflation tends to be fairly benign for utilities business models, but also the type of stocks that we select in Gloin are particularly well placed to be protected from low inflation and actually benefit from inflation as a growth driver. First of all, if we look at the very long-term history, this is not the first time that we see a spike in inflation. As you may remember, in the 1970s, we've had periods of very high inflation as well. But if we look at how the earnings of utilities evolved throughout that period, we see that there was no drawdown in earnings for the utility sector. These companies continued to grow their earnings very steadily throughout these periods. And as a result, we don't think that today's spike in inflation is a reason to worry about, because the same regulated drivers are still in place, and we think that the fundamentals of our companies are very solid. Where it is interesting, though, is to ask yourself the question, higher inflation leads to higher interest rates. And what does that mean for an investor? Now, it's interesting because long-term bond yields in the US are around 4%. And the dividend yield of US utilities is also around 4%. So you could ask yourself the question, should I take the risk of buying utilities equities if I can buy a 10-year bond that gives me the same yield? And that's a very good question. The issue is that bond yields are nominal and equity yields are real. What does that mean? If you buy a 10-year bond yield at 4%, it means you will get exactly 4% for the next 10 years, every single year. That's a nominal yield. If you buy a utility with a 4% yield, it's a real yield because it grows with inflation. So today you're buying 4% yield, but that yield is growing at close to 10%. So the 4% from today is 4.4% for tomorrow, is 4.8% for the year after, and so on and so forth. So the right comparison is not to compare nominal with yield, because that's comparing oranges to apples, as they say in English. You have to compare real yields on equities with real yield in fixed income, so inflation-adjusted yields. And the 10-year Treasury inflation-adjusted yield in the US sits at around 1.4, 1.5%. So still a very nice spread between the 4% you can get in equities and the lower percent you can get in fixed income. So my message would be, yes, there is inflation, and it could stay around for a longer time. The type of utilities that we invest in are particularly well suited to benefit from an inflationary adjustment. You don't need to worry about the balance sheets. The earnings will follow the trajectory of inflation and grow with inflation. And if you compare that to other asset classes, we think that the yield compares very favorably. I hope that expands a bit on this topic, and I thank you very much for your interest in Gloin.